Welcome back to another episode of the Old Fashioned Real Estate Show. I'm Brian Leverage.
And I'm Jeffrey Holst.
And we're glad to be here with you again, even though you're there.
Yes, exactly.
Yeah.
That's what he said. So we have a very interesting topic today. We're going to talk about 3 rules that every real estate investor must know. And we're going to do it right after this.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour out old fashioned real estate advice.
And what are those rules, Jeff?
Okay, so the 3 rules are known as the 1 or maybe 2% rule, the 70% rule, and the 50% rule. Now that's a lot of numbers, so we're going to dive in on those right now. So Brian, what is the 1% rule?
1% rule basically equates to you want to buy a property where the gross rent is equal to 1% of the purchase price.
Give me an example.
So you buy a house for $100,000, that house rents for $1,000 a month.
Okay, what if the house rents for $800 a month and it's $100,000? Does that meet the 1% rule or not?
Not from my understanding of it. No.
Right, because that would be the 0.8% rule. See, the thing is with the 1% rule is
it's not just annualized.
Right, it's just a handy rule of thumb. You take the monthly rent and you divide it by 0.01, and that's the purchase price, or you take the purchase price and multiply it by 0.01 or 1% to get the price that it needs to rent for in order for the deal to make sense, at least on the surface. And I think it's important here actually to talk about the limitations of the 1% rule, because just because something meets the 1% rule doesn't mean it absolutely works.
100%.
No, it's 1%.
Which is a multiple of the 1%.
That's true, 100 times in fact.
But that being said, yes, these are just sort of general rules, not to be adhered to very strictly. Like
rules
in other
of
words,
thumb, if you will.
Yes. There's a lot of properties that would meet the 1% rule even in today's market. And that's kind of the problem with the 1% rule, is that in a declining market, your values go down, maybe your rents go down. But if you bought based on that, and we're going to get to the expense side of things as part of the 50% rule here in a few minutes, you may end up upside down or cash flow negative every single month based on that.
Yeah, so the thing about the 1% rule that I find interesting is, 5 years ago, were you using the 1% rule?
Mm-mm.
What were you using 5 years ago?
It depends on what part of town I was buying in.
Right, but it was more than 1%,
It was more than 1.
Right, so it would be like, for me, in a decent area of town 5 years ago, I was looking for 2%. In other words, a $100,000 property would have to rent for $2,000 a month, or it wouldn't make sense. And we were buying, $50,000 properties that were like close to the 2% rule. They might have rented for $1,500, $1,700, but there was something more than 1%, right, is the point.
Well, so in Chattanooga, Tennessee, where we film this and where we do a lot of our investing, 5 years ago, you could find 2% deals all day long.
True.
And now they're mostly a thing of the past, or 5 years ago.
One thing to keep in mind here, too, is the lower the purchase price, the easier it is to find a 1% or 2% rule. If you bought a $25,000 house in 2010, probably would have easily met the 2% rule, because that would be a $500 a month rent. It probably was $600 or $700 a month. But that's one of the problems with the 1% rule, is that even if you do meet that percentage, if you're buying a cheaper asset, you might have additional expenses that make that rule of thumb not necessarily work. So the way I look at the 1% rule, if you're going to use it, is to use it as a filter for getting rid of things that you know don't work. So that means if you have something that doesn't meet the 1% rule, you can say that doesn't work. But just because it meets the 1% rule does not mean it will work. It means that it's worth looking into further.
Exactly. And I think that's a good segue into the 50% rule next.
Right, and the same issue applies there. The 50% rule simply states that you can assume about 50% of your rents will be eaten up in expenses, which means if you collect $1,000 a month, your expenses for taxes, insurance, and maintenance and things like that should equal about $500 a month.
And to flesh that out a little bit more, really, the old version, or the older version of the 50% rule, basically stated that portfolios of properties owned over time, that the gross expenses would reach 50%.
Right, which is one of the caveats with the 50% rule. Much like the 1% rule, it is a good filter if you're trying to quickly decide whether it's worth looking into something further or not, but it doesn't necessarily work in reality. For example, if you buy a house that rents for $1,000 a month and next month it needs a new water heater and a new HVAC system, you're going to spend a lot more than $500 on those.
Correct. And similarly, but in the opposite direction, a house that you've bought and rehabbed and put a new roof, new HVAC, new water heater, etc., one would expect, naturally, of course, their maintenance to be a lot lower. And so this is where it bears fleshing the 50% rule out a little bit more, is that you have kind of your direct expenses and then you have some of your indirect expenses over time. For instance, like capital expense reserves.
For example, a roof. A roof might only need to be replaced every 30 years. And when you average that over the 30 years, it might very well be still within the 50% rule. But the problem is that that year that you're doing it, you're going to have a lot higher expense. So you have to be thinking about those things and putting away money for your capitalized expenses over the life cycle of that remaining life on that roof or HVAC or whatever it might be. But again, the 50% rule is very handy for eliminating properties that definitely don't work. Not so handy for saying this definitely does work. And I think that's where most people make the mistake. It allows you to look at a lot more properties a lot more efficiently, but it isn't the end, right? Even taking the 1% rule or the 2% rule and combining it with the 50% rule doesn't necessarily guarantee that the property will work, even if it meets that metric, because some areas are less desirable, might have higher expenses, and that will throw the whole metric off.
I mean, there's things that don't show up on a balance sheet when you're putting a pro forma together, such as extended vacancies by buying properties in areas where there's, say, higher crime. Right?
And higher turn costs in those areas as well, because people that rent in cheaper areas tend to be more destructive on your property. And I'll give you an example on this too when we're talking about the 50% rule, because people apply this not only to single family houses, but also to things like apartment complexes, commercial buildings, all this other stuff. So I have an apartment complex not too far from where we sit right now. It's a 12-unit building. And I just checked out the expense ratio, and I'm operating it at about a 27% expense ratio, way lower than 50%. But the reason I'm able to do that is because I spent a lot of money on CapEx the last couple of years, and so my costs are down significantly. It's not reasonable to assume that it will remain at 27% for the life of that property, even though it is in a really great area and has reasonably low expenses. It might end up at 40%, it's possible, but it's not going to end up at 25%. Or I've seen some pro formas where they're at 15 or 20%, and it's just not reasonable over the long term.
And your expenses are going to vary, as Jeff sort of alluded to, based on the type of asset that you are investing in. For instance, apartments typically operate at a higher expense ratio than single-family houses do, right? And that's a function of several things. First and foremost is apartments are often taxed higher than houses are, right? So that's just baked into the cake right out of the gate. Insurance is higher, etc.
Right, and that's actually one of the reasons why mine's running at such a low expense ratio, is because even though it's 12 units, it's actually assessed as 3 separate buildings, meaning that they get into the residential taxes and insurance, which is obviously a huge advantage on that particular property.
And with apartments, and this, by the way, is not an indictment on any type of asset class, they're just different, right? And you just have to understand those differences when looking at investing in any of them. But for instance, apartments have a much higher turnover on an annual basis than a, say, portfolio of similar, single-family homes. With homes, again, depending on the price point and where they're located, you expect to have people stay 2 to 3 years on average, whereas on apartments, it might be more like 12 to 18 months.
Which has advantages and disadvantages, of course, because in a rising rent environment, higher turn actually can benefit you because you can get a higher rent. The other thing about apartments that I really like is that you can test the rent. If you don't know what the market rent is and you have a whole bunch of the same units, you can try one level, and if you rent very quickly, the next time one turns over, you can try a little bit higher and you can just keep ratcheting up. So anyway, way off topic there. Let's go to the third rule of thumb, which doesn't really apply as well to long-term buy and hold properties, and that's the 70% rule. So Brian, what's the 70% rule? And now a word from our sponsors. Who's sponsoring us today, Brian?
Well, we are, Jeff.
We are. How
Yes.
amazing. So we want to tell you about how you can save an enormous amount of money on your taxes and how Brian and I have been able to eliminate our taxes entirely.
You guys need to learn about cost segregation, which you can do by going to our website, oldfashionedtaxsavings.com.
Yes, and if you go there and you fill out the form, you can get a free, no-cost benefit analysis that will show you how much money you can save and what it will take to do that.
The 70% rule states simply that if you're flipping a house, or if you're an advocate of the BRRRR mentality, which is, buy, rehab, rent, refinance.
And repeat, BRRRR.
Oh, yes.
Because you got to do it more than once, otherwise it doesn't really work.
Which is a little harder to do in the current part of the market cycle that we're in.
It's a little tricky.
That you be all in. So your purchase, you be all in at 70% of what you think the after repair or appraised value would be were you to sell that property.
Right. So for example, if you think a property is going to be worth $100,000, your all-in cost would be 70% of 100 or 70,000, which means if you think it's going to cost you 20,000 to do the repair, the most you can afford to pay would be 70,000 minus the 20,000 or $50,000.
Yep.
It's a rule of thumb. Again, the caveat here is there's a lot of variables in this stuff, but what it will do is if you see that you're going to be at 80 or 85%, you know right off the bat that you're not going to have a safety margin sufficient to look at that deal, and you can throw that deal away. So when you're looking at, like, say, a wholesaler's list, you can very quickly sort out the properties that just don't make sense. But there are some things that you don't want to forget about. For example, you want to remember carrying costs. A lot of times people forget that when they're thinking about the 70% rule. You want to have that in your all-in
mortgage,
cost.
Utilities, insurance,
Right.
etc.
I mean, the interest, especially when you're doing something like a BRRRR or a flip, can often be a significant amount. For example, you might be getting 10 or 12% annualized interest, which means if you're borrowing $100,000, or say you're borrowing $70,000 in this case, it could be $8,000 a year, which means every month that it takes you to do that, you're adding $400 or $500 in costs. It could be more. I mean, Brian and I are doing a flip right now where our payments are $1,000 a month.
That's right.
Which is fine because we built that number into our return. But if we took 2 years to do it instead of 6 months, it would be a real problem.
So you need to be able to account for those. It's really, and when you're rehabbing a house, that's where I think this rule is a lot more apt. And the reason being, in a rehab to flip, to be clear, not a rehab, refi.
It can work in either, but
that's not the point. The point, though, is that when you're doing a rehab and you're wanting to resell the house for profit, obviously, sometimes with rehabs, and I've been in construction pretty much my entire life, when you start opening up walls, floors, etc., you almost always find hidden surprises that you didn't necessarily account for in the beginning. So that 70% rule kind of acts as a buffer in some of that, because really when you think about it, like using the $100,000 sale example, you're going to spend 6-8% between commissions and sales costs when you sell the house. So if you're all in at 70%, including carry and
sure, you might
everything
make
else,
about $20,000.
Yeah, you're looking at like $20,000, $22,000, give or take, and that's a pre-tax number, by the way.
Right, which actually brings up a really interesting point. So I know some people that do a lot of flips, and they say, if I can make $10,000 per flip, I'm happy. The problem with that is if the market turns against them or they find something that they didn't know, they can very quickly get below. If you discover one problem, for example, on that duplex that we're flipping, we discovered that there was a problem with the sewer line. Well, that could have easily cost $5,000 or $6,000. If your margin's 10, now you've only made 4.
Yeah.
You lost 60% of your margin, which is where that 30% buffer really helps. Because at the end of the day, if you miss something and you lose 10,000 because of what you missed and you only make 15, then you're still hitting that $5,000 to $10,000 goal.
Yeah.
It's not the end of the world. Obviously, you can do a lot more deals if you make money on them than you can if you don't make money.
And again, much like we said with the 1% rule, the 70% rule in most markets, as is the case here where we're at, is also a little more difficult to come by. But it doesn't mean you necessarily want to decrease that number to something higher like 75 or 80 unless you have a long track record and a lot of experience doing this sort of thing, because you often will get surprises, and those surprises, whether it be market driven or just property driven in certain cases, they can turn what looks like a decent project into an upside down one really fast.
Very quickly. And I think it does bear repeating, like the other two rules. This is just a rule of thumb. You definitely want to still run your numbers, figure out what everything looks like, and make sure you're okay with the end result and the risk associated with it, because all real estate investing comes with risk. And the only way you're going to eliminate that risk completely is if you don't invest in real estate.
Yep.
So with that, I would wish you guys a great and wonderful day. And I say to you, Brian, cheers.